what you're making of this India market outperformance at a time when the S&P 500 index in just the month gone by alone has fallen about 8.5%.
Yeah, absolutely. I think the micros in India are way stronger than the developed world. The GST collection, the fuel sales, the road traffic, air traffic, hotel occupancy, annual rates, room rates, order books of companies, exports. There are so many high frequency indicators which are telling you that the micros are very strong. Surely there is an impact on the margins because of raw material cost and freight cost, but that is something that we are dealing with.
Okay. So, Ravi, we have not got an earnings upgrade. Markets are not attractively very cheap. If at all, the impact of inflation and energy shock will be felt in next 2 or 3 quarters. So for FY23, are we in for no returns, low returns, negative returns? Because that is what the setting on the table seems to be indicating.
So we have already passed through a phase, right? There has been absolutely negative returns since October of last year. So it's almost been 7-8 months, maybe a couple of months more. But see, what I feel is that market reacts to uncertainty. And surely there is inflation and high bond yields and everything is around, but it is not unknown risk anymore. Markets are factoring in, portfolios are adjusting, central bankers are adjusting. Soon enough, tomorrow Fed will do its first 50 bips hike, and markets have factored in almost 7-8 hikes, leading to almost 3%, and bond markets have adjusted. So what now from here is the question? Will the growth sustain itself? Because I think if the growth sustains itself, then some amount of operating leverage can compensate for the margin impact. And market will look beyond the 1 or 2 quarters impact. We'll look whether this is derailing our 3-5 year story is not what we should be looking at.
So Ravi, when typically inflation comes back, markets will migrate to companies which have brand, pricing power, better cash flows, which is the HULs and the Britannias and the Nestle's of the world should start coming out. I mean, that's how typically markets have moved in the past. The challenge with that thesis, Ravi, is that consumer staples are expensive, consumer durables are expensive, quality is trading at a premium. So where will money migrate when inflation is coming back?
No, so there can be a temporary pricing power even in companies where, in industries where there is, the demand is too strong from the short-term, medium-term point of view. So traditionally, you wouldn't say hotel sector has pricing power, but today we are seeing, the room rates are high and people are willing to pay. Occupancy levels are also very high. So there is a cyclical aspect to the economy, which is in a very, very strong uptrend. And I think that is giving a lot of pricing power to many sectors beyond the traditional pricing power sectors. So I think those are the areas where one should look at in terms of business momentum from the next 4 to 6 quarters point of view.
Well, if I look at Britannia is up 4% today, Deepak Nitrate is up 2%, RBL Bank is up. So the markets are not looking bad at all. So what changes have you made, Ravi, from Jan to now? Because if the template around us has changed, which is value is coming back, growth is taking a back seat, commodity adjustments are happening, energy shocks are happening, how are you changing your portfolio positioning?
Yeah, so in the last 6-8 months, what we have done is we have reduced a lot of our chemical positions where we believe that market is factoring in a long amount of growth. I remember 5-7 years back when these stocks used to be valued in single-digit P's. Today they are getting 30+ multiple to more than 30 also. Some of them are 40-50 P multiple to an earnings which is likely to not sustain. At least the growth rate of the earnings is not likely to sustain. The earnings might sustain at a higher base. So that is something that we have reduced. Another place where we have increased systematically over the last 6-8 months, our weightage is in the financials. Now, when I say financials is a very, very broad term. There is private banks, public sector banks, housing finance companies, commercial vehicle financiers, there are asset financiers, and then there are gold loan companies. So our bet has been on the cyclical recovery in the businesses and cyclical recovery in the real estate. So we like to focus on companies that are addressing these opportunities even in the financial space, whether that's a bank or an NBFC.
Good morning. And, today morning, Nikunj said steel is perhaps the new gold. So when you're talking about the new bets you're making, the jury's always been divided when it comes to metals. What about metals?
No, I think metals are definitely in a strong uptrend, and usually the commodity cycles are driven by the supply shock rather than the demand. Demand remains steady over a period of time, but it's the supply that creates the cyclicality. And we are going through one such supply shock. So I don't see a reason why the steel prices should come down, and hence even the steel stocks should sustain itself at this point of time. We have not entered a phase where the cash flows are used or the balance sheets are leveraged to acquire large assets. So usually you buy the asset value and you sell the earnings in commodity companies. But at this point of time, it looks like the momentum will sustain for some more time. However, we have not taken any position in commodities, but we do take some derivatives play. If commodities are going to do well, there are some companies that cater to the commodity cycle that will also do well.
Pharmaceuticals, you're such an authority when it comes to the pharma pack. We've seen the pharma pack being in a negative phase, and the last time you were here, you were saying you're waiting for the positives to pan out. Has that happened?
No, so I think it's been a prolonged winter for the pharma companies. The sector peaked in 2015. We are in 2022 now, and it's been a downturn all along. And the primary reason for that was, of course, there was a bunching up of a lot of supernormal profits in few products. All those profits have definitely been wiped out. And I'm talking about the US generic place. The US generic place has witnessed, they have witnessed big price erosion. Those price erosions have reduced to a large extent. In terms of US FDA issues also, the number of issues have reduced. We got a 2-year window where the focus shifted to COVID portfolio, and there were no incremental inspections. So there was no incremental bad news. But now the physical inspections have started again. That is good news as well as bad news. Good news because all the held up approvals have started coming. Bad news that some of the facilities can actually get into trouble again. But from a longer term point of view, I believe pharma industry has learned its lesson. A particular site might not pass a US FDA approval, but I think overall the companies and the cultures have shifted to adhering to the US FDA standards. And I don't think India can be replaced in the world in the pharmaceutical supply chain. So it will remain a fertile ground. But of course, you have to be selective in terms of picking. The profit pools that remain in US are fewer now. Biosimilars, inhalers, injectables, specialty and complex molecules. These are some of the areas where the profit pool still remains from the next 5-7 year point of view. And companies with a larger exposure to these areas are the ones that one should be focusing on for buying a stake. Domestic, on the other hand, has witnessed actually, because of the inflation and the pricing being priced to inflation, there is a 10% price that has been taken. But what has happened is that last 2 years, the portfolio shifted towards COVID, and that COVID portfolio has now taken a knockdown. So that inflation will not be enough to, inflation in their base portfolio will not be enough to adjust for the COVID impact.
Past, whenever we've chatted, you've been a big believer in the digitization theme. We've all known your opinion in the likes of Route Mobile, and it's for everyone to know what that stock has done in the last 2 years or so. But what next? Where is it that you are now betting big on? And also, if I could just, connect that with what's happening with the IT services industry right now. After the recent decline, have there been any attractive opportunities for you to buy into?
So first I'll address the IT services part. IT services, I believe, of course, it's a derivative demand from the digitization and the boom that is taking place in the US market. I think in the near term, the stocks have run up quite a bit. The valuations are at the higher end. And now there are some challenges on the attrition front and the margin front. And there has been some disappointment on the growth front as well in some of the companies. So I would say this sector, one should be, wait for 6-12 months, see how this attrition challenge is addressed, and then maybe you can find a better entry point, is what my feeling on the IT services is. On the other hand, I think digitization, there are many ways in which this digitization theme can be played. Unfortunately, a lot of them are outside of the listed space. And I believe that over the next 1-2 years, a lot of companies will come to the market. Good part is because of the steep correction in the US companies, tech companies, the valuations have come down, whether it's the IPO or whether it's the private equity market, the valuations have come down. There is a little bit more sanity and in the valuations that are being spoken about. But the growth will sustain. So at some point of time when these companies come, there will be some very good companies. If you can find companies that fit your valuation criteria, then one should be focused on those. So whether it is the Nykas of the world or Zomatos of the world, where we will have many more such companies getting listed on the markets, and that is where I think it's a happy hunting ground in terms of the quality of the company. In terms of returns, one has to obviously time its entry.
So have the Zomatos of the world, Ravi, fallen enough for you to add more positions?
No, so I think some of them in the previous cycle were so overpriced that it will take a little bit of time before for them to catch up with the growth. Growth is coming through. The models, I mean, without naming any particular company, the models are strong. The industry structure has consolidated. So I feel confident that these companies will be around 5 years, 10 years from now also. Of course, they are changing their model. They are going into, very fast delivery under 10 minutes and all that. And they are also addressing non-food segments in terms of delivery. So this transition, how they handle it and what kind of cash burn it leads to, if at all, is something to be seen. But otherwise, I feel companies are solid. They are not going to go down under, and one should be keeping them on the radar. Whether to buy or no is the question to address over the next 6-12 months.
Achha, that's a long haul. But Ravi, great to have you on the show as always. Good speaking with you, and we'll chat again soon.
Thank you so much.
Thanks.